Done. Now, so it's over. Good news. So here's what's going to happen. So here's what's going to happen next. Chris and Zoe are going to take the quizzes up to my office. It's going to go in alphabetical order, and they're going to leave it on my desk. And sometime soon, I will start grading them. So I will grade and grade until I get done grading. And when I'm done grading, I will let you know the quizzes are graded and you can come pick them up. They will be face down, and I'll tell you where to go find them in alphabetical order. Okay, so this isn't borders, no browsing through. You know where your name is, pick your quiz up. I can't think of an efficient way in which I can return these quizzes without sucking up a lot of my class time. The reason I asked you to write your name on the back was that, so if you didn't, not a big deal. I will copy your name, but it makes it less work for me if you've written your name in both places, the front and the back. So it'll be face down alphabetically. When I send you the quiz, the email saying your quizzes are done, I will also send you the Excel spreadsheet with my solutions and a grading template. Okay? I'll tell you up front, I grade quickly and I grade noisily. What does that mean? I just get it through. So this isn't building an aircraft. Yesterday I was in a, on a Boeing aircraft coming from Portugal, zero defects. That was what I was looking for. This one I'm willing to accept I will make mistakes. So here's what I want you to do. If you see a mistake and the grading template clearly shows that I've made a grading mistake, don't bitch and moan about it. Don't stew in your juices. Just say, look, you made a mistake. I'll fix it and we'll move on. Okay? On the multiple choice, I have an answer, but I'm willing to listen to your answer if you feel that you have a basis for the answer. But I'm not a pushover. So if you give me another answer, I'll push back. And if you can show me that there is a basis for your answer, I will go along. So I am not the Pope. I am fallible. So in a sense, if you push back and I can think of a good reason why your answer might be right, no. So so watch out for that email saying your quizzes are done. It will come sooner than you think. Okay. Because I have 3 quizzes today, 650 quizzes. So my job is to get your quizzes back to you because I want, taking up room in my office and, I want to get them back to you. So watch out for that email. I know you're in no mood to kind of listen more about corporate finance, but you have no choice. Okay? So today we're going to move on from the cost of equity to the cost of capital. So equity is one way of raising capital, right? What's the other way of raising capital? You can borrow money. So today I want to focus in on what exactly goes into debt. Sounds like a silly question. You're saying, I can see it on the balance sheet, but I'm going to give you what I'd look for to classify something as debt. And you're already going to see that accountants don't always call things that are debt as debts. It might not show up. And then we're going to try to attach a cost to the debt. How do we get a cost over equity? We start with the risk-free rate. Then we came up with an equity risk premium. Then we estimated beta. In fact, we did that whole dance. We need a cost of debt. Luckily, that dance is a little less involved, but we need a cost of debt. Along the way, we've got to deal with the hypocrisy of governments that tell people not to borrow money and then write a tax code that encourages you to borrow money and how it shows up in your cost of capital. So let's get the first component of these processes in place. When I think about debt, I think about a contractual obligation. Whether it's short-term or long-term, I don't care. If I have a contractual obligation, I have essentially the equivalent of debt. So when I look at a company's balance sheets, I'm going to look at any interest-bearing obligation you have and treat it as debt. Until 2019, if you were a retailer or a restaurant, you were able to borrow money and not show it in your balance sheet. In what way? You entered into a lease, a 12-year lease, a 15-year lease, contractual obligation. Yeah, you signed a lease contract. But until 2019, accountants and for whatever reason, decided not to treat it as debt. We're not bound by accounting rules. So no IFRS or GAAP looking over our shoulders. We're essentially going to treat any contractual obligation, including lease, as debt. Now that accountants have come around to you, say, why should I have to do this? Sometimes you might disagree with what accountants have treated as debt. And there are other items like leases that you might want to treat as debt, other contractual obligations. So with that in place, let's talk about estimating the cost of debt. Whenever in finance you run into questions, best to go back to first principles. The cost of debt, that is in a cost of capital, is the rate at which you can borrow money long term today. Let me repeat that again. The cost of debt is the rate at which you can borrow money long term today. Two key words there, today and long term. Let's take the today part. You can show me all the debt on your books, right? You borrowed 2 years ago, 5 years ago, 7 years ago. I don't care. Why? Because you were in a different circumstance. Rates were different. I care about the rate at which you can borrow money today. Why long term? You can borrow short term as a company. And sometimes it makes sense for you to borrow short term. Your working capital needs, you might take 6-month loans. I fully accept that. And much of the time in the last century, maybe not right now, when you borrowed money short term as opposed to long term, there was a term structure for interest rates, right? Which rate was usually lower, short term rates or long term rates? Short-term rates are usually lower. In 95 out of the last 110 years, the yield curve has been upward sloping. What does that mean? When you borrow 1 year, it's lower than a 10-year loan. So if you borrow money short-term, the rate will look lower, right? And you want me to give you the benefit of that lower rate and the cost of capital, and I'm going to say, no, I can't do that. Why is that? You are borrowing at a lower rate. Why am I not giving you the credit? Or you've got to reinvest. When you take a 1-year loan to run a business, it's not like you're one and done. You're going to have to come back next year, the year after, the year after, the year after. At what rates? Essentially, it's not even the risk issue. When you think about forward rates, the way we get forward rates is you take a long-term rate and we roll into the forward rates. The rolled over cost of your 1-year loan over 10 years is going to be roughly equal to the 10-year cost of debt. So I'm not saying you can't borrow money short term, but I'm going to attach a long. You know what? This makes your life very easy. Because now when you look at debt, you take all debt short term as well as long term, and you attach a long term current cost. You think, how the heck are we going to get a long term current cost? You play the role of a banker, and I'm going to be a US company. And I'm going to come to borrow money from you. Right now, when you lend me money, what's the absolute lowest number you would charge me? What's the base from which you're going to build off? The risk-free rate, the T-bond rate, right? Why T-bond? Because you're looking at long term. Right now, it's about 4.25. Notice it's 4.23% this morning. If you remember just 2 weeks ago, it was 4.6%. We talked about things shifting while you're watching them. So 4.25%. Will you lend me money at 4.25%? If you did, you wouldn't last very long as a bank, right? Why not? Why can't you lend to a company at the same rate as the treasury rate? Because I might default. And there are differences in default risk across companies. So the cost of debt boils down to, it's very focused. Unlike cost of equity, you get distracted by what country do you operate in, what your business is. With the cost of debt, you only one question. Will you pay me? Will you pay me? Will you pay me? And everything you do is about, hey, will you pay me? So when you look at me as a company and you want to assess that credit risk, remember, banks have been doing this for as long as there have been banks on the face of the earth. What are some of the things you will look at? Derek? You're going to look at my history. If I have a history of defaulting every 2 or 3 years, you're going to say, well, you probably have a lot of default risk, right? I mean, if you're an individual, this is what your credit score kind of gives away about you, right? So you're going to look at my history. What else? Ravi? Before you look at that, what do I use to pay the debt? What I earned, right? It'll be nice if I have lots of earnings because, so you're going to look at what I generate as earnings. Will you care about the stability of that number? Ashwin? You can choose. So what else would you want to look at? You're going to also look at other obligations for my earnings. You're going to look at my earnings. You're going to look at the stability of the earnings. You're going to see other claims on those earnings. Why? Because you want to make sure you don't end up last person in line, not be able to collect. And after all of that, you charge me a spread over and above the risk-free rate. Let's call it a default spread, for lack of a better word, or a credit spread. And that credit spread is going to be wider if you see more default risk in me than if I'm safer. Everybody agree so far? So this, you don't need to take a finance class. You lend money to somebody. This is your first question. Will you pay me back? And if you're concerned about me paying back, you charge me a higher interest rate. If you each picked a company, you're going to come up with this question. What is the default risk in my company? For some of your companies, your life is going to be easy because somebody else would have done this for you. What are we talking about? A ratings agency, S&P, Moody's, Fitch, has attached a rating. I know it's sloppy. You're taking somebody else's assessment. Think of how much work it saves you. So for those of you with companies with ratings, don't look a gift horse in the mouth. You have a rating. You can convert that rating into a default spread. Why, if you have a rating, is it so easy to convert into a default spread, Ashima? If you told me your rating is triple B, why am I able to gauge what your default spread is based on the rating? It gives you a benchmark, but I need to convert that benchmark into a number. So what can I see in markets that allows me to do? Are there triple B rated companies that are traded out there? You can see what people are charging as default spreads. The advantage of having a rating is even if your debt is not traded, there are others out there with debt that's traded, bonds that are traded, and you can look up the spread that those. So this number, will it change over time, those spreads? Did equity risk premiums change over time? What caused them to change? Fear and greed. You think the bond market is immune from those things? Default spreads are going to go up and down. But basically, you give me a rating, I can tell you what the default spread is right now. I add that on to my T-bond rate. I'm done. Think of how much simpler this is than the beta equity risk premium debts. You open the door, you're saying, if I have bonds traded, why can't I just look up the yield to maturity on a bond that I've issued, right? AT&T has bonds outstanding. No, doesn't that give me a cost of debt? Maybe. And here's why you should be cautious about you looking at the yield to maturity of a bond that your company's issued. Can a risky company issue a safe bond? When you buy a bond, it's backed up by something, right? As a company, if I carve out my safest assets and back up your bond can be very safe, even though I'm risky as a company. The danger of using a single bond and taking the yield to maturity is depending on how that bond is structured. If you take that rate and extrapolate to the whole company, you will come up with a cost of debt that's too low. The nice thing about having a bond traded, though, is you will have a rating. So when you have a bond traded, rather than use the yield to maturity, go with the rating. So I was just doing this a couple of weeks ago. I was looking up the ratings for every rated company in the world. There are about 2,500 rated companies. The US is disproportionately represented because the bond market is deepest here. There are 48,000 publicly traded companies in the world. 2,500 have ratings, and I gave you an easy way. You're saying, what the heck do we do with the other 45,500? Here's what you cannot do. And many people use this. They say, I don't have a rating. I can't come up with a default spread, so I'm going to use a book interest rate. You know what a book interest rate is? You take the interest expense, you divide by the book value of debt. What does that reflect? The rates at which you borrowed money at. It also reflects whether you use short-term or long-term. It's a non-starter. It is not a long-term, forward-looking cost of debt. So if you have a company that doesn't have a rating, you got to act like a ratings agency. And before your stomach drops, ratings agencies are the most transparent entities in the world. Not because they want to, but because of what they make public. So you look at S&P or Moody's, they give you the rating of every company that they rate, right? It's in the public domain. They also give away the game. They say, look, we look at mostly public information, and these are the ratios we use. In fact, on the S&P website, on the cover page, they listed the 8 ratios they used. They included things like, EBITDA by fixed charges, looking at Ashima's point about, hey, what other charges are there? They looked at, how much debt the company already has. So pretty common sense ratios. So they tell you what the rating of every rated company is. They give you the 8 ratios that they use to come up with the rating. So in the early 90s, when I said I want to come up with a way of estimating the cost of debt for non-rated companies, I did some reverse engineering. I took the rated companies, I took the 8 ratios they claim to use, all public information, and then I looked to see whether there were clues in the ratios I could use to guess the rating. We're going to call this a synthetic rating process, synthetic because we're coming up with the rating. So I initially looked at all 8 ratios. And then I said, well, I don't know whether all of these ratios matter as much. How do I tell which ratios are carrying the load and which ones are along for the ride? And that's a purely statistical question, right? You look at the difference in ratings, you look at the difference in ratios. One by one, I started crossing out ratios. That doesn't seem to matter. That doesn't seem to matter. And ultimately, I narrowed down to one ratio, which for non-financial service companies explains about 50 to 60% of the differences in ratings across companies. It's called the interest coverage ratio. You know what the interest coverage ratio is? It's operating income, EBIT, earnings before interest and taxes, divided by the interest expense. Think like a lender. You want that number to be a high number or a low number? You're lending to somebody. You want a high interest coverage ratio or a low interest coverage ratio? You want it to be as high as possible because it gives you buffer. So we're going to talk about estimating ratings for non-rated companies, but once I estimate a rating, I go through the same process. One final point. By the time you get to the cost of debt, you've already made some choices, right? Remember when we did cost of equity, I said you got to choose a currency. You're valuing a Russian company, you decide to do things in euros. You can do everything in euros. You get to the cost of debt, you're locked in by that choice. You know what causes people to get confused here is they look at the currency a company borrows in. And I say, I have to compute the cost of debt in that currency. And that's okay, but if that's different from the currency in which you estimate your cost of equity, you can't mix the two. So you got to make the same currency choice you do with the cost of equity. So I'm going to start with my easy companies first. The companies where I had a rating. I'm going to confess that I trusted the ratings agencies up front. And then I'll go talk about how you might want to test that trust. So 3 of my companies had ratings. Disney and Deutsche had single A ratings. Vale had an A minus rating. So they're S&P ratings. I could use Moody's ratings. Don't worry too much about it. 98% of companies, the S&P and Moody's ratings are actually very, very similar. So there's actually a table I have where you can see what a Moody's rating translates into an S&P rating. So when there's disagreements, there are small disagreements. You're not going to get big ones. So pick a ratings agency, get the rating. And in 2013, those ratings gave me default spreads of 1% for the single A rated companies and 1.3% for the A minus rated companies. I'm done. I've got my risk-free rate. Remember, it was I'm doing all, in this case, Disney and Vale in US dollars. I use the US dollar risk-free rate. Added the default spread to it. I have my pre-tax cost of debt for those 2 companies. For Deutsche, I was doing everything in euros. I start with the euro risk-free rate. I add the default spread to it. I have a pre-tax cost of debt. So the default spread goes on top of whatever currency risk-free rate you've chosen to use. I come up with the pre-tax cost of debt. And in the case of RIA, if I want to convert my dollar cost of debt into a RIA cost of debt, by now this equation should be familiar. What do? I bring in the differential inflation. So if at this stage you say, I want a cost of debt in RIA, it's not a big deal. I take the dollar cost of debt, 4.05%, and I convert it into a RIA cost of debt by bringing in the extra 7% inflation rate. So I don't even know what this, take that out of the, is equal to 11.19. That should be out of there. So it's 1.0405 scaled up for the additional inflation in there. So I've got a cost of debt for my companies for which I have a rating. Saying, what about the rest of my companies? I'm going to use the interest coverage ratio. I have the interest coverage ratio for each of these companies. Remember, you can compute this for public, private. It just EBIT, earnings before interest and taxes, divided by interest expense. So I computed the interest coverage ratio for all of the companies, including my rated companies. You're saying you already have a rating, why bother? I wanted to see if I got a synthetic rating for these companies, whether it was pretty close to the S&P rating. And if it wasn't, what I might be missing that S&P had caught on, or what S&P might be missing that I might have caught with the ratio. So there's my interest coverage ratio for 5 of my 6 companies. So operating income divided by interest expense, interest coverage ratio. Just looking at the interest coverage ratio, if I ask you which of these companies would you feel safest lending to, Disney and Baidu are way up there. You're saying, but Baidu is a risky company. It is, but borrows so little money, you still have $23.7. It could have its income drop by 50%, you're still going to be okay. It could have its income drop by 90%, you're still going to get paid. So clearly it's taken into account the riskiness in how much it borrows. And the riskiest company here would be Tata Motors at the lowest interest coverage ratio. But interest coverage ratios don't give me default spreads. I've got to take this interest coverage ratio and convert it into a rating, right? So at the start of every year, I do a lookup table. You tell me what your interest coverage ratio is, I'll guess your rating. This lookup table is pure data. There's no theory. Remember those 2,500 rated companies I created? And at the ratios? Basically, this lookup table came from looking at those 2,500 companies, saying, what do I need to get a AAA rating? And I noticed that life wasn't fair there. If you are a large company, and I'm going to define large as a market cap greater than 5 billion, the ratings agencies were much, much more lenient on it. They gave you a higher rating for a particular interest coverage ratio. Smaller companies, so I created 2 lookup tables, one for large companies and one for small ones. So let's take Disney, large cap, developed market company. That's your best case scenario. Big company in a developed market. Their interest coverage ratio is 22.57. If you look at the lookup table, 22.57 blows through the top there. They're going to have a AAA rating, at least based on the synthetic rating. Remind me again what their actual rating was? It was single A, right? Clearly, I am overrating the company. And we'll talk about what might cause that overrating. You go to Vale, large cap, emerging market company. And again, I'm going to use the life is unfair argument. If you're an emerging market company, you're treated like a small cap company by the ratings agencies. The rating they get with 11.67 is a AA rating, small cap or risky. So with each company, I look at whether they're large cap or small cap, emerging or developed, and take the interest coverage ratio, and I get a synthetic rating. Now I have a rating for each of my companies, including the rated companies. But for the unrated companies, I have an estimate of what I think their rating would be. So I took a pause and I said, why is my rating different than the S&P rating? Let's go through some of the things I will miss when I use just the interest coverage ratio to estimate the rating for a company. Any ideas? Yusuf, what might I miss if I just use the interest coverage ratio? So you're a lender, right? You're basing it just on interest coverage ratio. What are some of the things I miss? Yes, Ashi. And what might, because remember, we have to stick with number-based numbers, right? Because you can't do this individually for companies and you can't. So one of the things that you might look at is this is last year's interest coverage ratio. If you have a company where things change over time, it's volatile management, volatile business, the interest coverage ratio will shift over time. So one easy fix then is instead of using last year's interest coverage ratio is to use an average over time. You could also argue that, hey, this company has a nice operating income, but there are other things, other fixed charges you haven't considered. It could also be qualitative, which is some companies have been around a long time, they've always made their debt payments. You say, that makes me feel good. So I'll concede up front that when you use an interest coverage ratio to get a synthetic rating, you're probably missing a lot of things that ratings agencies use. But let's see how much we're off. With Disney, my synthetic rating was AAA, right? The actual rating was single A. And here the difference was easy to explain. If I used an average interest coverage ratio for Disney over time, rather than just the 2013 operating income, which is a really good year, my ratings very quickly started to move towards single A. So what would I do? I'd stay with the single A rating because obviously the AAA rating overstates the credit standing for Disney. For Vale, my synthetic rating is AA. and S&P's rating is A minus. What do you think I'm missing by just using the interest coverage ratio? Remind me again where Vale is located? In Brazil. And in 2013, people thought that's a risky market, it's an emerging market. Ratings agencies factor in where you're listed. If you're a Nigerian company, you're going to struggle to make it into the A's, even if you're a nice, safe company. Why? Because you're thinking about country risk and how it plays out. If you're an Indian company, you're going to struggle to make it past double, triple B, A minus. So that difference is almost entirely the country risk component. Again, what am I going to do? I'm going to stay with the S&P rating, saying I hope and pray that they've captured the country risk in that A minus, so I don't have to worry about my cost of debt. And for Deutsche, if you notice, I didn't even compute an interest coverage ratio. Why was that? What's the interest expense for a bank? I'm not even sure what it measures, right? Because when you put deposits in a bank and they're fixed rate, you have a fixed deposit, the bank pays you an interest expense. So with banks, interest coverage ratios become almost useless in judging ratings. You know what the biggest single determinant for ratings for a bank is? Is the regulatory capital ratios. If they're overcapitalized with a lot of capital, they'll get good ratings. If they're a bank that is viewed as very dicey, it's regulatory cap, then your ratings are going to be much lower. So if you want to create a synthetic ratings table for a bank, it'll almost entirely be driven by tier 1, tier 2, tier 3 capital ratios. I've never bothered. I just take the rating. Banks are almost always going to be rated, and I use it to get my cost of debt. Now for Bookscape, I have no choice. I have only a synthetic rating. I take the 1.3% default spread, add it to my risk-free rate, I come up with a cost of debt of 4.05%. I'm almost there. I've got a cost of debt for every company. Let me do that for Tata Motors just to complete the process. For Tata Motors, I did not have an actual rating, unlike Vale, where I trusted the ratings agency to get the country risk. I had a synthetic rating. The default spread I got for the synthetic rating was 0.70%. So if I treated Tata Motors as like any other US company and I gave them, I would stop there. But it's an Indian company. And here the unfairness kicks in again. To get the cost of debt for Tata Motors, I had two default spreads, one for the company and one for the country. In a sense, you see what I'm reversing, right? How do I get the risk-free rate in rupees? I start with the government bond rate and backed out the default spread. Now I'm adding it back because Tata Motors can't borrow at a rate lower than the Indian government. The sovereign risk is in rupee terms. And I'm coming up. You're saying, why didn't you do this for Vale? Because I actually had a rating for Vale and I was doing everything in US dollars. If I were doing things in reais and I had a synthetic rating for Vale, I would do the same thing. Yes. Yeah. So in India, for instance, if you get the local CRISIL is the local ratings agency, that rates Indian companies relative to other Indian companies. A AAA from CRISIL is not a AAA from S&P or Moody's. It's a AAA relative to the Indian government. So you can add that default spread, but you then have to add it to the government bond rate. Don't add it to the risk-free rate. You got to bring in that government default risk. So I've got a pre-tax cost of borrowing for all of my companies, right? But here's where what governments do affects my cost of borrowing. How many of you do your own taxes? I haven't done it yet. It's looming over me. But sometime between now and April 15th, I'm going to open up TurboTax, which is a rip-off entity if you ever know one. The amount of add-ons they get by the time you're done with your taxes terrify me. I don't even look at it. Because I've got to file for 5 different states, why every one of my kids is in a different state, and I happen to become the tax preparer for them. Now, how this happened? Okay. But let's say you're doing taxes and you run a business. You have $1 million in income, and you have $100,000 in interest expenses. What are you allowed to do in computing your taxes? You're allowed to deduct the 100,000 and report 900,000 in taxable income and pay taxes on that. That is the tax benefit of debt. Debt lowers your taxable income, it lowers your taxes, and in effect, this is what it does. If you borrow money at 8%, And your marginal tax rate, we'll talk about what the marginal tax rate is, why it and only it matters, is 40%. You're in effect paying 4.8% in taxes. You pay the 8% in taxes, you save 40% in tax. Why marginal? Because think of the example I gave you. You had $1 million in income and $100,000 in interest expenses, right? So what do you report as taxable income? 900,000. Think of where you saved on taxes in the last $100,000 of income, not the first, not the middle. There's another tax rate that floats around in corporate finance and valuation called an effective tax rate. That's like an average tax rate across all your income. You can't use that to do cost of debt. It's got to be a marginal tax rate. Where will you find the marginal tax rate? In the tax codes. Don't look for it in your company. It's got nothing to do with your company. So in the US right now, at least in March of 2025, it could be different in June because there's a tax code working its way through. The federal marginal tax rate is 21%. You had state and local taxes, you're at about 25%. If I borrow money in the US and I'm a money making company, that's key, right? Because the IRS doesn't mail you a check for 25% of interest expenses. I'm effectively going to be able to take whatever my borrowing rate is and multiply it by 1 minus 0.25. What you see here are the marginal tax rates are used in November of 2013. You're saying, why is the marginal tax rate for Disney so high? Because in 2013, the US had one of the highest corporate marginal tax rates in the world. It was the most dysfunctional tax code written in history because it was written in a different time when US companies basically had no choice but to take it. Not only did the US have the highest corporate marginal tax rate in the world, you are taxed on all of your income globally at the US marginal tax rate. So if you made your money in Hong Kong, there's a corporate tax rate of 15%, at least in theory. But the way legislators write tax law, they don't think through the consequences. You know how that extra tax was supposed to be levied on you? You had business in Hong Kong, you paid 15%. The US tax rate was, let's say, 35 or 40%. You were taxed on the difference, but only if you moved your money back from Hong Kong. I don't know what legislators think would happen if you write this kind of tax code. So if you're a multinational, you have income all over the world on which you're paying well below 40%. The US government says, when you bring it back to the US, we're going to tax you. What are you going to do? You're not going to bring it back to the US. A 5-year-old could have thought through this consequence. And in 2016, there was $2 trillion in what was called trapped cash. Apple alone had $150 billion trapped outside the US. Trapped in what sense? Because the minute they brought it back, so let me tell me what I can do with the 150 billion if I'm Apple. I can invest it anywhere else in the world. I can leave it anywhere else in the world. Here's what I cannot do. I cannot pay it as dividends or buyback or use it for buybacks for my shareholders. I cannot invest that money in the US. Talk about perverse consequences. You have legislators complaining that companies don't invest enough in the US, and then what do? They write this damn tax code. Luckily, and this is one of there are lots of things about the 2017 tax reform I don't act. This was one of the things that was fixed. So now if you're a multinational, this is true for the rest of the world. In fact, there are only 6 countries that used to do what the US did. And you don't want to know the names of the other 5. This was not the company you wanted to hang out with. The rest of the world was in this on this system of your tax wherever you do business and you're done. 2017, that law came in. And the other thing that 2017, of course, changed was the marginal tax rate. It went from 35% at the federal level down to 21%, which basically brought the marginal tax rate in the US almost to exactly the global median. Much of Europe is around 25%, with the honorable or the dishonorable exception of Ireland. Right? And how they managed to hang out at 12% and are allowed to stay in the EU, I don't know. Because this is clearly a setup for money moving to Ireland, and seems like a loophole in an EU where you have one country at 12%. As they bring in Eastern Europe, this is starting to expand. There are lots of Eastern European countries where the marginal tax rate is 10%, 12%. Money finds its way to low tax locales. Business might not, but money will. The marginal tax rate is essentially the tax rate. And you'll notice it's 36.1% for Deutsche, 29.48%. You're saying that is a very weird number. You know what happens to corporate tax rates? There's a tax rate, and then there's a one-time add-on because the country is having a deficit problem. Supposed to be one time. 37 years later, you look and say, how come we've been paying it for nothing ever is one time? It kind of stays on. So you get these strange looking marginal tax rates. And there's my after-tax cost of debt. Take a look at those numbers and remember what the cost of equity looked like for each of these companies. And what's the first thing that jumps out at you? This is a really low low cost. And that's always going to be true. When you do this for your companies, don't be surprised that the after-tax cost of borrowing is well below the cost of equity. But don't take the next step and say that must mean debt is better than equity. We haven't gotten that step yet. But debt is always going to be cheaper than equity. Even before a tax benefit, and you kick that in, the only part of the world where you're not going to be able to do the 1 minus t is parts of the Middle East, where interest is not tax deductible, more for religious reasons. They don't want companies borrowing money, it's passed through. Much of the rest of the world, there is a tax benefit to borrowing. So you got a rating. What do you use the rating for? To come up with a default spread. To the question of do default spreads change over time? Well, there's your answer. This actually tracks default spreads at the start of every year. And you can see if you take, let's pick a particular rate. Let's take triple B. Triple B is investment grade. It's that magical cutoff. And we'll talk about why companies don't want to fall below triple B, though those constraints have become looser. So if you take triple B, you can look across 2021, 2022, 2023, and you can see that between 2021 and 2023, the spreads went up, and at the start of 2025, default spreads have decreased. If you get a chance, go look at implied equity risk premiums, and you're going to see the same pattern. Why? Because the same people in both markets. If they get scared in one, they're going to get scared in the other. Default spreads do change over time. So you want an updated default spread. You can use my numbers from the start of 2025. But I'm also going to give you the place I go to get those updated spreads. And if you want to update it between now and May, try it out. It's not a big deal. You download the spreadsheet. They give you the spreads on the start of every month. If you go to Bloomberg, you can get it at the start of every day. That's a little bit of overkill, but default spreads do change. And in some years, they change a lot more than in others. Remember the COVID year? This is what default spreads did during the course of the year. There's 214, February 14th of 2020. You know what the significance of that date was? That was the date that the Italian government announced that they'd found COVID cases on the Italian mainland, and there was no connection to either China or cruise ships. So we woke up to the fact that this is a pandemic, it's everywhere, and between February 14th and March 20th, the world melted down. Look at what happened to default spreads. They doubled across the board, AAA, and in fact, the lower ratings were hit even more. So if your cost of capital for a company on February 14th was based on a rating, and the rating didn't change, your cost of debt would still have changed, and of course it should. The world's getting riskier, it's getting more difficult to raise money. But luckily for us, that crisis passed quickly, at least in the markets, and the default spreads by the end of the year had come back down. Perhaps not to pre-crisis levels, but to levels pretty close. So during some years, the spreads will change. So here's my task for you, right? You've got a company, and now that your quiz is behind you, look up the rating for your company. Where are you going to find it? Go into Google search. This is where Google search is useful, right? In the old days, you'd have to go find the Moody's pages. Go to Google search and say company, bond rating. And 95% of the time, if your company has a rating, it'll be there somewhere. Right? If you want to use Grok or you want to use Gemini, be my guest, ChatGPT. This is a good way to use those as tools. So if you have a rating, if you can't find it, don't try to get blood out of a stone. So I'm going to keep looking. 16 days on Google search will not help you find a rating for a company if it doesn't have a rating in the first place. use the interest coverage ratio. I'll send you this little Excel spreadsheet. All it does is it's got the lookup table built into it. You enter the EBIT and the interest expense for your company. It'll compute the interest coverage ratio. Along the way, I'll ask you, is your company a big company or a small company, risky? So I'll make you, and I'll go to the lookup table, come up with the rating, and the default spread is updated to the January 2025 numbers. If you have a US company, for the moment, use a marginal tax rate of 25%. Why for the moment? Because there's talk, at least in the tax code, I don't think it's going to happen, of lowering the marginal tax rate, at least for subsets of US companies. I think we're pretty much, because if this would have become a much more consequential question if the election had gone a different way, because remember, the tax code that was fixed in 2017 sunsets at the end of 2025. So if nothing is done, in 2026, the marginal tax rate for US companies would jump back up to about 40%. So the best case scenario now might be it stays at 25%, you use 25%. If you're in a different country, you're saying, how do I find a tax code? I actually stole a table I found on PwC. I told them I'm stealing it. No, send a lawyer after me if you want, which actually lists corporate tax rates by country, which is an immense plus, because otherwise you have to know how to read 50 different languages to go through the tax codes. It lists the corporate tax rate by country. It's on my webpage. You can download. I'll send it as a link after the, on the email after class, but use that marginal tax rate. Couple of final loose ends that I want to tie up before we end this discussion. So we talked about two ways of raising capital, debt and equity. And for most of you, that's it. That's what you'll find. But for a couple of your companies or a few of your companies, there will be this pain in the neck of what I call hybrid securities. What are hybrid securities? They're part debt, part equity. The simplest example of this is convertible debt. What is convertible debt? It's traditional debt, where there's an interest rate and a principal payment, but you can convert the debt into equity if share prices go up. That's an equity option. That is really equity. It's hybrid because it has both in there. The other is this pain in the neck security called preferred stock, which in the US is just debt with the name equity attached to it. Preferred stock has a fixed dividend. It's different. Latin American preferred stock is just common stock without voting rights. US preferred stock, you get a fixed dividend. So just like a coupon. The only reason you can't treat it as debt is that that dividend is not tax deductible. So if you throw it in with debt and put a 1 minus T on it, you're going to understate it. So some bad news. If you have a company with a significant amount of preferred stock, you have to open up a third part to your cost of capital. Equity, debt, preferred stock. Not a big deal. And the cost of preferred stock is just the preferred dividend yield. It's the preferred dividend divided by the preferred stock price. Okay. I told you not to pick financial service companies, so you're taking 80% of the preferred stockholders off the map. Because banks are among the biggest issues of preferred stock. You know why? Because the regulatory authorities allow them to treat preferred equity as equity in that tier 1, tier 2. It's a very expensive way of borrowing money because you don't get the tax advantage, but you get to do this virtue dance of I issued equity, I'm a safer bank, when in fact you've issued debt and you don't even get the tax benefit. So if you have those, then deal with them and move on. One final point, the weights that you need. There's an absolutely categorical first principle rule. You have to be market value weights, as opposed to what? Those book values you see on balance sheets. And you know how much of a tussle this is when you try to get CFOs to buy into it? For a very simple reason. If you look at the background of all of the CFOs in the face of the earth, where did most of them start off? 48,000 CFOs. Every company, I'm sure, is a CFO. What was usually their starting point? What discipline did they start in? They were accountants, right? It's changing. Maybe in the US, you might have some MBAs who become CFOs but the bulk of the CFOs in the world are accountants, and I don't blame them. They're very attached to their balance sheets. And they come up with every conceivable excuse for why they want to use book values. And I'm going to give you the ammunition to push back, because you're going to run to CFO and say, why can't I use book value weights? First, they will tell you book value is more reliable than market value. You know why? It doesn't change as much. In fact, we know exactly how often book value changes. For a US company, how often does book value change? 4 times a year, every time you do a quarterly report. You want to make book values even more reliable? Let's go to annual. Forget about the quarterly. In fact, why do it even annual? Let's do it once every 10 years. It's absurd. But to argue that something is reliable while the world is changing around you, I think misuses the word reliable. Book value is not more reliable. It's actually less reliable because it never changes. Second, they will tell you that they're just being conservative. They're accountants and I'm being conservative. But here's why that doesn't work. Take your company and try to estimate the cost of capital first with market value weights and then with book value weights. Let's say there's debt and equity. What's generally going to happen to your debt ratio when you go from market value to book value for almost every company? Book value of equity in most companies is 1/4, 1/5, 1/10 the market value, right? So when you use book value weights, debt is always going to look more weighted, 30%, 40%. You take Netflix, use book debt ratios, you come up with like 55% debt ratios. You put in a 55% debt ratio into your cost of capital. What are you going to do to your cost of capital? You're going to pull it down. This is not conservative. It's the exact opposite. Book value is not more reliable, it's not more conservative. And if you're computing return capital, we'll come back and talk. It's true we use book values there, but for a very different reason. There are no good reasons, or even semi-good reasons for using book value. Use market value weights. So next session, when we start, we're going to talk about estimating the market value of debt so we can get these debt ratios. And then we will move on to measuring return. So if you haven't read your case, which I know you've had other things on your plate, please read the case. You're looking at me like, what case? There was a case you got, so read the case before you come to class next session, because it'll help. It's a market now. There are the bonds that are traded with that rating, right? They have interest rate. You take the interest rate and compare it with the traded.
Just the concept of enterprise value. Well, I was saying that like enterprise value the cash to add back to it.
So tell me how that played out in the debt ratio percentage.
Well, because normally I would say like you refer to as maybe that's
It's debt plus equity, which is not, so debt, firm value is debt plus equity. Enterprise value is debt plus equity. Not debt.
okay. So it's they're different.
So they are different. Firm value is determined by the enterprise value. So when it plays out in debt ratios, because you use a net debt ratio, which is net cash out, that's perfectly okay. We stay net debt all the way through. You got to do net debt for the level, net basis, net debt ratio, then you do cost of capital. The end cost of capital you're going to get is going to be roughly the same.
Sure.
But you got to be consistent all the way through, even if the net debt ratio is a negative. You got to be okay.
So when you're starting with a firm value, that's like enterprise value plus like non-operational assets. right? Like it's not equivalent to
Yeah,
enterprise.
but it includes cash. So the non-operating assets, an entirely different kettle of fish. That should be neither in firm value nor in enterprise value because it's complete math.
Yeah.
But cash is usually the difference between firm value and enterprise. But if you look at a company's financial balance sheet, the assets include cash. It is part of the assets. So the debt is the gross debt. And of course, you could act like you have no cash and net the debt out. But that's okay, as long as you recognize that that's how you ended up with no cash and why isn't that?
Sure, thank you.
Hi.
I was trying to find a couple of times that that's what they don't have to bring on. And it's not brand, it's a prejudice. It's restating the rest of the
Yeah,
anyway,
it's just
so
probably the issue.
just
Yeah.
so I'm using your model,
Yeah.
actually, I'm not sure whether like in the first sheet, that you asked us to like, whether the companies, the emerging market or
Development.
development market, with that effect.
Because I put you into the risky column. If you pick emerging market, even if you're a large cap.
Yeah, I'd like to get.
For you, you might be small cap and emerging, you're gonna end up in the risky column anyway, because remember, you have two lookup tables. That is to tell me whether I should use the first lookup table, which is for big, safer companies, or the second one. You're gonna end up in the second table, no matter what.
So how many factors actually would that add? The cost of debt, so first of all, the converted interest rate or.
Everything, yes, really, you can take everything that a company does. The question is which ones actually make it. Remember, all these ratios are highly correlated with each other.
Yeah.
So if you have 16 ratios and the correlation across the ratios is 93%, you might as well use one ratio, because when that ratio goes up, all of the other ratios are going to move with it. It's not a question of whether other ratios matter, but whether the interest coverage ratio captures the information. So an EBITDA to fixed charges is almost perfectly correlated to the interest coverage ratio. So when the interest coverage ratio decreases, that one is going to decrease as well. It becomes a redundant ratio. You have already brought an interest. So you're looking for ratios which carry information that's not in the interest coverage ratio. Right? Those ratios they matter. So you could argue that among the size of the company, for instance, is one of those steps, right? So we're bringing separately the lookup table. Variability in earnings. You would expect companies with more volatile earnings to have a lower interest coverage ratio. If you want to build that in, create an interest coverage ratio for volatile earnings companies, and what that will show is you have to get a higher interest coverage ratio to get the same rate. So that mostly other ratios are kind of irrelevant. Right? So it's really the level of earnings, the volatility in earnings, and maybe the level of debt you have, the debt to capital ratio. But outside of that, there's almost no other ratio that's going to help you. Yeah. I mean, the Altman Z-score brings in things like the working capital ratio, but that's a different, that objective there is to figure out whether you're distressed or not. That's not the end game. It's to come up with a synthetic ratio.
For the cost of debt,
Right.
teach us next class, right?
The cost,
To-
no, cost
I
of
mean,
debt.
I mean, the market,
Market,
price of
yeah.
it. I want to know that, actually.
No, if you can price a bond, in fact, when I go through it, if you price the bond, it's going to look very familiar. Because you have book value of debt and the interest expense, and you have a maturity for the debt.
I know, but interest rate during the way changes, right? And that.
Yeah, that's why the book value of debt will, so because how the price of a bond changes when the interest rate changes, right? And you know how to compute the price of a bond if the interest rate goes up, right? You put in a new interest rate, exactly the same process. So market value of debt is actually bond pricing extrapolated into book debt
But how can we know the average
maturity. It's good.
due to maturity of the?
You don't need the
all
yield
the
to, no,
bonds
you
of
don't
the
need the
company?
yield to maturity.
I mean, the current.
You
I
don't
mean,
need any of
no.
that, right? Because you already have the pre-tax cost of debt, which
Oh,
should
we
be
know the coupon.
that, so you know the coupon, you know the face
Yeah.
value,
Oh, yeah,
and you
yeah.
have the pre-tax cost of debt already, you're ready. So there's no need to compute what the yield to maturity would be. This should
yeah,
be
you're right.
the yield to maturity. And you're going to use that to come up with the present value of the debt.
What about banks? The banks loan? We
You
use
go-
the same
that-
thing, right?
no,
We use the
But
same.
yeah,
model.
if you were gonna value a bank, but we never do debt ratios for banks.
No, I mean, like the back loan of the company
Yeah.
is considered debt as well. So
Yeah, That's
it's
why,
on-
that's what market, when you talk about marking loans to market, that's all you're doing. You're taking the loan payments due,
Yeah,
you take the face value of the loan, and you discount them back at today's cost of debt for that loan, reflecting higher interest rates, more default risk. So guess what? If you loan money to somebody in 2020, you look at that same loan today, the market value of that loan will be significantly below the book value of the loan because interest rates have gone up and you've got to take the present value of the remaining payments.
So that means if you want to use this method, we will have to list out all the bonds and the bank loan of the company and then.
You don't need to, you just can treat them as an aggregate, right? So you know the total,
You know the coupon, the aggregate coupon.
because it's the interest expense in your income statement, right? Where does the aggregate coupon go? It goes into an interest expense in the income statement, right? It doesn't disappear into thin air. So if you look at the total interest expense on the income statement, it's a collective coupon slash interest rate that you've paid on all of the existing loans, right? So that becomes, if you look at the balance sheet, look at the book value of debt, that's a collective value according to accountants of the face value of the debt.
But what
And-
about the T? The period.
There's a weighted maturity, right? Most companies will tell you when the
Oh, they
debt
will
comes
tell
due.
you.
It's in the footnotes.
Oh, okay.
In fact, Bloomberg, if you go in and type in CRPR, it'll give you the weighted maturity of the debt, because it's public information, you know, because the loans are not in thin air. So they give you a weighted maturity. So you take the interest expense, you take the book value of debt, you take the weighted maturity, and you apply today's pre-tax cost of debt. You got the market value of debt.
Last question.
Yeah.
By the way,
Yeah.
so if you want to use a capital to value the cost of recurring